Hello.
Yo, 60, what's good?
Why you sounds like that?
Cause I'm baked, bro.
What's up with all this kind of accent?
Just how I roll, man.
Tell me a joke.
Yo, nobody's doing nothing around here.
Boon Tee and YCX can have a YouTube video on Reddit on 10x in 5 years. So far, YCX very confident on Reddit, but if you can give guidance so we more confident would be good. Okay, this one for Reddit, have to ask YCX. Maybe can have a session with him in the future, but I haven't really discussed with him on the Reddit. So I will skip the first question since this question is directed to YCX. Next one. What are the goalposts we can look at in the coming quarter yearly release that give us confidence Reddit is on track to 10x like the NVDA videos? Okay, same for the first one. I will skip this because it's talking about Reddit. Okay. Next one. Can you broadly speak about what constitutes a durable economic mode? Durable means lasting a long time. Okay, for these economic mode questions, I think we cover in the past now. So if you look at the textbook economic mode definitions, right? So these are a couple of examples like network effects, switching costs, economies of scale, intangible assets. I think if you understand the business and understand the concept of these economic modes, right, it is not difficult to understand why all these economic modes, right, will give, let's say, like pricing power to the business. And usually if you own a business with good economic modes, it will turn out to be good results. The only concerns that you want to consider is that, let's say, if the companies have a economic modes, and then everyone knows that, and the valuation is too high, maybe it didn't play out that well because all this good stuff about the companies might have been priced in, right? So that's the only thing that you want to consider. But usually when we describe companies to have, let's say, like economic modes, right? Usually in terms of the business, right, they can last very, very long one. So maybe I think to understand this, right, it's good to give you a couple of examples. I think the best one and the easiest one to understand is network effects. Say, for example, let's say if you are using some social network, right? You're using Facebook, Instagram. So you go to these social network sites because your friends are there, and then more friends are there means it will attract more people into this network, right? So it is very hard to displace or challenge an existing social media, social network platforms. For example, let's say when Elon wanted to create his social network, right, he can actually create a new one from scratch, but he knows it's very difficult. That's why he's even willing to pay tens of billions of dollars to buy Twitter back then, right? Because the economic modes is already there. People who are used to using, let's say, like Facebook or X or Twitter back then, right, they are very reluctant to go and open another account. So that's why you see those, they are new one, right? It's very, we find it very challenging for them to challenge the existing companies just because of the network effects, right? So there are others, like each of these, right, there are good examples just to showcase that it is very durable when we describe it as economic modes, right? Say, for example, let's say if your company is using Microsoft Word, Microsoft Excel, right, ask them to switch to another platforms that is, for similar kind of features, right? Because it's not just like adding new, let's say, like software providers is relatively easier, but if you are already relying, your entire processes is already using Excel and you want to move to the other one, it is very, very difficult and very, very costly, time consuming, cause a lot of problems. That's why most companies, they will rather just stick with the current providers as long as it is just running as per normal. Unless really the pain point is really too painful, or there's workloads that the current provider is not able to satisfy, then there's opportunity for new providers. If not, right, for the existing workload, for the existing processes, right, if the current process is working, usually they will just stick to it now. So that's why you see, let's say for companies that are using Windows, using, let's say, like Excel, Microsoft, all this, right, they won't switch to another provider's one. They will just keep on using. That's why they will just keep on paying the monthly subscription costs and so on. So that's why if you understand the pain point, right, you understand the pain, how costly it is to switch to another providers, right, then these providers, the existing providers, right, they have the economic modes, meaning that they can actually increase their price over time and still their business, right, their clients, their customers will not run away. So this is what we call the economic modes. Economies of scale is also quite easy to understand. Usually these are companies that already have a huge market share. Say for example, let's say TSMC, right, I invested in. So you look at the foundry market shares, right? I think they have like 60 or 70% market share. And then on the advanced manufacturing, they have like 99, close to 100% market share, right? So for other companies that want to challenge their positions, right, it is very difficult because they don't have the scale. You need to produce large volumes in order to have all these volumes, right, to share the fixed costs. And fixed costs, I'm referring to, let's say, like R&D costs, right? So for new companies, if they spend so much money into R&D to be manufacturing at advanced level, right, they need to have the scale. And to have the scale, they need to fight with the existing incumbents, right? For example, like TSMC, right? So it's very difficult for them to compete with them just because of the current scale that the companies is already have. So this is also good examples, right? So all these so-called economic modes, right? When you say it is economic modes, to me, it is usually durable one. If it is not durable, right, we won't call it economic modes. So let's say if companies that is doing well recently, just because of their product is very good, but you know that this kind of products, right, the competitors will come up with something that's better, and then they keep on replacing, right? These kind of things, you will notice that you won't call it as economic mode because it is only temporary, right? So your questions is asking like, what is the, like, how do we know it is durable, right? Wait, what's your question, sir? What constitute a durable economic modes, right? So I mean, just look at the examples that was provided. You look at like when these kind of effects, right, you can just bring in some examples and you can see similar patterns, right? Then you can call it as this is businesses with economic mode. Right? It's not that hard to understand one. And to me, economic mode, durable, they are the same thing. So that's my comment on these questions. Let's say if your questions, keep it coming. And for those who are new to this channel, right, from time to time, I will have all these Slido sessions just to answer any questions, right? So let's say audience or viewers who have any questions that want to ask me, they can just shoot the question here. Even some questions turn up here is live questions, right? So I usually, when I do this kind of Slido, I don't spend like a lot of time to do a lot of research because I want it to be more random things that pop up on my mind and then I just speak to it. So that's how I conduct my Slido session. So that's done on this one. Next one. In your opinion, when does a business have pricing power? How do businesses strengthen and maintain this? I believe these questions came from the same persons as the previous question because why we talk about all these economic modes, right? Usually when we say economic modes, it ties with pricing power because let's say if you only have economic mode but you don't have pricing power, it's hard to drive these two, right? Usually economic mode means that your customers stick to you regardless of whether you are increasing price. By increasing price, I mean increasing in a way that is reasonable. Not like, not every companies can just 10x their price and then their customer will still stay, right? We are talking about like stuff like, for example, every year 5 to 10% or even 15% kind of increase, right, in pricing, and still the customer are not running away, right? So these are the businesses with economic mode. So these two are similar things. And when it comes to identifying companies with good pricing power, right, it's also not that difficult one. You just need to look at their financial statement, look at their gross margin, look at their net margin, and then you can tell whether the companies, right, whether they have pricing power or not. I've give you two examples here. The first one is Apple. So if you look at Apple gross margin, right, in the past it is around, let's say, about 38%, and then recent year, right, it went up to about 46%. But if you look at their segments, right, within the companies, they have many segments. They sell iPhones, they sell Mac, iPad, and then they also have all bunch of services, right? So there are businesses that have relatively higher margin, and then there are businesses that have lower relative margin. But why this increase, right, is because I think in terms of the percentage, right, I think that there's larger percentage come from higher margin business. That's why this percentage go up over time. But if you look at their, like just looking at iPhone alone, right, or look at their iPad alone, right, just individual business lines, I think their gross profit margins, right, is relatively stable over time. They don't change a lot from time to time, meaning they set up like a gross margin, right, and then they just like try to maintain that as much as possible. Let's say if the input cost has increased, they can pass it to their customer by increasing the price of their products. But of course, when this increase, right, meaning that they're selling more of the higher margin pieces, definitely there's something good to have. So you can see here, right, from 2016 until now, it's not like a short period of time, right? This is like 10 years period, right? I'm sure that there are other companies, for example, like Samsung, Huawei, and other companies that's trying to like sell similar items, say for example, like smartphone, right? But and other companies, I'm sure they are cutting price just to grab market share from Apple. So, and Apple, of course, they can lower their price and then try to maintain their market share or even increase their market share, right? But they don't do so. They know that they have enough customers that are willing to pay for their products, and these customers, they stick to their products. They don't move to the other providers. They don't move to other brands, right? So that's why this is what we call as like economic moats. So there's branding. Branding is also one form of economic moats. So and you can see that they just maintain the gross margin, the target gross margin, and try to maintain the price, and still in terms of their growth, at least it's not going down over time. Although people say Apple growth has slowed down quite a fair bit, I will agree to that. You just look at their growth rate has kind of like stagnant, right? But when it comes to their margin, it's still relatively healthy. And to me, this is one form of economic moat. So you just look at their historical financial statement, you can tell one. So for any companies that you are studying, right, you just look at their historical, let's say like 10 years margin, right? Whether their margin is going up or down, from there you can tell. Let's say if margin coming down, right, that means they have to cut prices just to either maintain market share or just, you know, like sell to their customer. If they don't cut, right, maybe they will experience negative growth already. So that's why for these companies, you just look at their margin, you can have a good idea already. I give you one examples of companies that people say don't have pricing power, which is Tesla. So you look at Tesla, right? If you look at margin in the past, right, let's say from let's say before 2021, right, there was the period before they actually ramp up Model 3, right? So they are quite in a bad situations. I won't look at those period. And then after that, right, they have around COVID periods, right, they successfully ramp up Model 3, and then you can see that the other automakers, they have some sort of problems with their supply chain, right? And Tesla, it seems that they are doing quite well with respect to their supply chain. Hence, they are able to increase their car prices, right? So their margin improved up until around 2021 or 2022. And then subsequently, right, you look at their gross profit margins from close to 30% now drop to about 17%. That's like 10% drop in terms of their gross margin. And in terms of their net margin also dropped to now single digit, right? Why they have to cut all their car prices, right? It's not like they are feeling generous about it. It's more like they are facing all these competitive pressures from the other automakers. Hence, they have to cut. If they don't cut, right, they have to, their growth rate is even lower. Maybe they will experience even worse negative growth rate, right? And then when that happens, they can't amortize all these like fixed costs over large volumes, right? Then they also have a problem there. So they have no choice, because car industry, right, automakers, right, is quite competitive. They have no choice but to cut prices. Hence, you look at their gross margin and their net margin is trending down in the recent few years, right? So let's say for those who invest, like let's say like Warren Buffett, right? They talk about economic moats, they talk about financial statements. You look at this kind of financial statements, you will agree that this is exactly the companies that Warren Buffett will not invest in, because just from the numbers you can tell that these companies don't have economic moats as of now. Of course, Tesla bulls, they will say that all this is just not the full picture. The full picture is we are talking about autonomous driving, FSD, we're talking about humanoid robots, all these things, right? Of course, there's a bull thesis that you can come up with from the other aspect, but just looking at their historical numbers, right? Historical financial statements, right? These are the real things. These are the revenues, earnings, right? I mean, from here, it's hard to argue that Tesla has economic moats all these conventional economic moats. So this is one good example. Like you can see that gross margin up and down. For some companies, let's say like Semicon, right, their margin up and down, that one is just cyclical of the business. But for some business, you look at their margin going down to single digits, right? And there's no sign that they can increase that back up, right? So those are the business that is without economic moats. these are commodity business. I'm not saying commodity business means that it is not good to invest. Some people, they like to bet companies. Let's say they look at their margin drop to, let's say, 2%. They buy it, and the margins for whatever reasons from 2% suddenly go up to 5%. Then their earnings can shoot up by 2x, right? And then they can cash out. Some people, they like to invest or speculate in this kind of business, right? But for me, I will definitely look at the business, look at the margin, make sure that I invest in companies with economic moat, unless it is companies like Tesla, there's some other reasons to own it, right? So yeah, so that's my comment on the questions of this economic mode. Okay, that's done on these questions. Well, there are many questions that is asking YCX, but today YCX is not here. So say for example, this one, like to ask YCX if Reddit shares can 10x in 2 to 3 years, why he never sell his NVDA shares to buy Reddit shares, or he thinks NVDA shares can go higher than 10x. I think these kind of questions, let's say he posts it in Telegram, YCX is happy to share his opinions on these kind of things, right? Yeah, so engage him on inside the chat group. Okay, so I'll pass this because Reddit I have no idea. Next one. In business or investing, by your experience, what are the factors for consistent success? What are those that lower our chances of success? Well, I think this is a very broad questions. These are good questions, but very broad. Let me think of one, right? I think here you say consistent success, right? My answer to this question is you need to have consistency. Yeah. So if you look at how we operate, right, as an individual, whether you are individual employee or whether you are individual, let's say like business owner, or whether you are talking about business, right? All these businesses, peoples, we all behave in a certain way. Okay, there's behavior to it. And for other people who wanted to, let's say like use you, right, or wanted to partner with you, right, they will observe your behavior, and then they can't observe your behavior if your behavior is erratic, like keep on changing. Okay, they want some sort of consistency in your behavior, and once you have demonstrate some consistency in terms of how you work, what's your style, what's the value that you can provide, and then once there's enough track record, right, then people will value this kind of like, let's say your skill or value that you can bring to the table. So consistency is very important, sir. So let me give you some examples. You see, let's say even among the content creation scene, right, there are many people. From time to time, every few months, every few quarters, you will see new content creators, and they will tell you, oh, see how I print options, passive income, 20,000, and then the other people say, this is how I invest in these businesses, and then some people come out and write some reports. Wow, I think US is getting into stagflations. Then, I mean, it is very noisy because there are so many informations out there, right? Let's say if I am, as a viewer, I look at all this content, right? The first thing that I will check is the track record. Like this person says certain things. What is his track record, right? Say for example, there's one article that I just read during yesterday, right? So this person said that US is likely to get into stagflation. I checked the blog that he posted before. So just a few months ago, he talked about US exceptionalism, and then a few months before he talked about Trump will make China great again. Then suddenly now he talked about like getting into stagflation. So you can tell, right, from just 2 or 3 articles, you will know that the persons, right, don't have any track record. Then I check the person's LinkedIn, right? The person's okay, like 3 internship, and then after 3 internship, he is currently in his, I think, 1 or 2 years work experience, right? You can tell that this person, which is good, is trying to write some articles, trying to add values. But when you look at the track record, it's like, there's none. I'm not saying that person without track record shouldn't try anything. Yes, you should try. You should, try to add value as much as possible. I think those are good. It's just that I can't place any trust in terms of whatever that you have written because of you keep swinging in terms of what you want to write, right? So if you keep swinging, then there's no track record there. So you need some sort of consistency. Like if you are wrong, it's fine. You just admit that you are wrong. I think those are fine. But in terms of how you present yourself, how your working models, you need to be consistent. You need to find your ways and then just be consistent with it. So you want to find some style or some approach that can consistently bring you up, and not something that trying to keep on looking for new ways to do things. So I think that is quite important. And you can observe similar things in companies as well. There are companies, right? They know that this is where I am. This is where I can shine. This is where I can compete, right? This is where I can create new market, right? They will just keep on executing in those areas. So I think, of course, one good example is that NVDA. Okay, NVIDIA, they have been in GPU business for a very long time. In fact, they can pivot to CPU and try to compete with Intel, but they didn't do so, right? Because they know that in terms of CPU, they don't have an edge there. They don't believe that is their place. So they just consistently just focus on the GPU and make GPU great, right? So from GPU just serving, let's say, graphic to now GPU become general purpose GPU, right? So now become something that power all the AI. So they have been very consistent to tell people that they are in GPU business. You see, compute, right? It's not just GPU, right? There's CPU side of things, there's ASIC side of things. Now even people come up with ASIC and then try to challenge NVIDIA. It's not like they suddenly now pivot to ASIC again, right? So they are still like consistently execute on what they are good at. So and then people knows that, okay, when we talk about GPU, we think about NVIDIA just because of the consistency. They've been in this business for so many years. So that is, the track record, the skill, choose your place, choose your style. I think that's where it will shine if you show some sort of consistency there. So I think in terms of like news flow, in terms of peoples, I noticed that there are so many people who just keep on flip-flop here and there. And the moment I sense some of this like flip-flopping, right, I know that this person I cannot trust already, because it's like I can't catch you, right? And that's also the reason why when people talk about trading, I don't listen, because you see they talk about trading, they say, I'm shorting this market now. Then when the market, when the price went up, you say, have you lost money? Then they say, I earn money. Then how do you earn money? By shorting, right? So you see, for trading, yes, of course they allow themselves to flip-flop, because you can long a company, suddenly you send something bad, then you straight away short. Okay, you are allowed to do that. You are trading. So that's why, but we can't discuss why you are long or short a company at this moment, because the next second, right, you pivot already. So why do I want to spend time to understand what you are investing at this moment? It keeps changing anyway, right? So that's why I'm not saying that trading is useless. I'm not saying that. I'm just saying that I will not spend time to try to understand, just because of these things is just change too fast. There's nothing, no knowledge that you can build over time because of this flip-flopping. So yeah, I think this is true for business and investing. You notice that for the companies that I invest in, right, you notice that from beginning of year till now, some of these companies I just hold, because I know that these are the companies that's consistently executing on their businesses, on their strategy, and I just consistently hold. So you see, all this is like come back to the same theme, right, which is the consistency. Okay, I hope that's useful for you. That's on this question. In your experience at work or investing, what was the hardest lesson you had to learn? Please share the insight again. I think come from the same person. Yeah, I think, again, broad questions, right? Let me think. Is there anything that I can share? So I think when it comes to work, right, and when it comes to investing, there's another things that will share some common theme one, which is you need to keep on learning. And by learning, I mean the technical skill. Because I notice, right, you notice, let's say a big companies, right, there are some hierarchy, right? So let's say you have the CEO, then you have their exco members, so you have the CFO, the CIO, CTO, whatever. So there are many all these head of departments, right? And then under the head of departments, you have different teams, you have different sub teams, team leads. So this is typical org chart, right? But let's say, you watching this video, right? I don't know, you could be already quite high in your organization, or you could be somewhere in the middle. I believe most people watching this is somewhere in the middle, okay? And if you are at the middle, how do you move up, right? I think there are some qualities that you need to be able to have, right? You need to have these kind of abilities for you to move up. First thing is that you need to operate and think in a way that is on par or similar to someone who is your higher up. okay, or even 2 levels above you, what kind of like thought process, what kind of like strategy, what kind of how when look at certain problems, how they will think about that problems, right? That is the mindset that you need to have before you can move up. Because let's say if you don't have that kind of mindset and then people just promote you, right, then you will struggle one, because you can't even lead those who are below you, because people see that, okay, if I have certain problem, I check with you, you are my boss, and then you can't even help me, and I feel that your solutions or your suggestion is even worse than what I have, right? You can't, people don't trust you, and you will struggle. Let's say if you haven't operate at that level. And what helps you operate at that levels, right? Of course, there are many qualities, say for example, like those leadership skill. I mean, those are definitely important, but I think the technical skill, right, is something that is very important and is always underrated one. Because for sure in your work, right, there will be situations where sometimes you feel like, how come your boss also, you find it very hard to have good discussion just because your boss don't have good enough technical skill to converse with you, right? So those kind of situation will happen one. And if you have technical skill, right, it will serve you well. And this is same is true for, let's say, like when it comes to investing, because we all invest in all sorts of companies, right? It could be companies that is, even let's say companies that people say is commodity, right? But there's still a lot of technical knowledge that is required for you to understand the industry, the sectors, the competitive dynamics, those kind of things. So you need to read one, whether you read transcript or you read the industry specific knowledge. You need to keep on reading. If you don't read these kind of things, right, you don't have the technical skill, you don't even know how to process the information, the news that is available. It's same piece of news you read, and then you ask someone who is in the industry and read and tell you, and you discuss, right, you will notice that how come people have so much, power or so much knowledge to triangulate these informations and make sense of the situations compared to you, just because of the technical skills that you lack. So I think all this learning is continuous one. You really need to have all these technical skills in order for you to advance, to become a better investor, to become a better employee, to become a better business owners. So the learning has to be continuous. Yeah, I think that's all that lesson. If you talk about lessons, I know people sometimes they talk about like what kind of mistake that you made in the past, right? I have plenty of mistake, but I think maybe I share it in some other sessions. So can't think of like one incident to share. Okay, next one. On forecasting, how do you think about optimism and room for error? Do you ask yourself what are the scenarios for permanent loss? So I want to comment on this, the first term here, the forecasting. Actually, if you notice my sharing, right, I don't talk about forecast that much, right? I don't talk about, I think my forecast for this company is like they will generate X amount of revenue, X amount of earnings. Of course, we can look at other people's forecasts. Sometimes I look at forward PE, right? And forward PE by definition is price divided by forward earnings, and forward earning is forecasted earnings for the upcoming 1 year, right? So I will look at other people's forecasts. I mean, just for fun, not like I look at that and use that to make my investing decisions. And sometimes if even I use all these chart, right? Let's say this Coifin, right? They are able to provide some, like forward revenues, and then I might look at that. And sometimes, let's say during the earnings season, and then the CFO mentioned about they expect a certain number of revenues next quarter. I look at that. Nothing wrong with look at that. It's just that I don't do my own forecasting. And I know there are good investors that do their own forecasts. They say that, if the market is forecasting 20 billion revenue and I think it will be 22, then if I'm right, then I should, compensated for that, right? Just because I bet on the right companies, right? It's just that I don't do that. The reason is because I think I don't have edge when it comes to forecasting, okay? That's first thing. And second thing is that I think if you want to invest in a companies, right, and this forecasting, nobody can forecast, let's say like 3 years ahead one. That one, I think people will agree. It's very hard to forecast more than 1 year and beyond. It's very difficult. And forecasting, if you talk about like just short-term forecasting, whether it's 1 quarter or whether it's upcoming 1 year, right? To me, it's still a short-term thing. So, but if you look at my my Telegram group, right, invest for the long term, right, I talk about long-term things. I don't want to talk about like short-term things. Because let's say if I invest in this company just because I forecast the short-term performance is good, is that means that if I forecast they will be lower, then I need to sell? The answer is no, right? So that's why I think forecast to me is more like a short-term thing, and I don't do that kind of things. I do like long-term. I want to invest in companies that have moats, that have, let's say, like I know this company will do well. But do well doesn't mean that it must grow like what 30% per year, right? Not the case. Let's say if consistent, they are able to consistently grow at even 10 to 15%, right? To me, it's good enough, right? So but the stability is important. The quality is more important than just talking about like just forecasting, right? So that one I need to be clear. That's why if I don't do forecast, right, then there's not much error to talk about, because I just don't believe that much. I prefer to look at their track record now. In fact, there's one book, right? Yeah, I think it's called Investing, Learn from Darwin's. If you there's one specific chapter that talk about like the investor, the author, right, is also like he don't trust all this forecasting as well. I think that is a good chapter to learn about now. So okay, that's on the forecasting. Second one is like, what are the scenarios for permanent loss, right? This one I would say that is very difficult one. I think for every investor, right, you definitely want to avoid permanent loss. Permanent loss means that, let's say, some drop in share price, right? Share price drop is okay, because let's say if the business is intact, right, the share price will rebound one day, right? But let's say share price drop, but you look at the business is already gone. Say for example, let's say if it is a business that have pricing power, suddenly another competitors come up with a better products, and then your customers just shift away, right? Then your business is gone. That is permanent loss, right? So these kind of things, I would say that every investor, even long-term investor, they want to avoid. The question is that how, right? So I think there's no shortcut to this. What you have to do is just keep on monitoring the situation, monitoring the financials of the companies, and from there try to understand the competitive dynamics, try to understand whether there's any new competitors that pop up, try to understand whether the competitors suddenly have a big leap through, suddenly come up with better products. You want to observe those, right? So just to make sure that the business still intact. So that one, you have no shortcut. To me, you have to invest. So for me, I think another way is that you look at my portfolio, I don't have a positions that is like, let's say, more than 50%, right? It's also to avoid this kind of situation. Let's say a company that I own, let's say it's like 10 to 15% right? By the time, let's say, there's some sort of like bad news coming, and then new competitors that come and grab market share, and then you look at the companies that you invest in, is like really the trajectory is not doing well, right? It's going downhill, right? Maybe by the time it's going downhill, the percentage in terms of my total portfolio, instead of like 10 to 15%, now it's already dropped to, let's say, like 7%, 5%, right? So if it dropped to a lower percentage, then I can look at it in a more objective manner to say that, okay, do I need to cut loss just because of this business turned out to be a permanent loss situation? So it's not that painful when it is like lower than, let's say, 7 or 5%, right? So you can do that, or whether you want to judge whether this is just a price that is correcting, not the business, and you still have conviction on the long-term business, the viability of the business, right? So you can make that kind of judgment from time to time, right? So that's why I think, let's say if you have like more than 50% allocation in one company, and people ask you how do you avoid this, right? How do you know it won't turn out to be a permanent loss, right? Because to be fair, every companies, right, definitely there are competitions, right? If you don't believe, you just read their 10K and 10Q. There's a segment that talk about the competitions that they are facing, one. They have to describe that every company, including NVDA, including Tesla, they're definitely competitions. So you still need to monitor the competitions, so to gauge whether they are facing stiff competitions, and whether the business that you own remain, the thesis remain valid. So that's something to monitor. Okay, who more pro, Boon Tee or YCX? This one 100%. No, I don't want to hedge this. It's 100% YCX, definitely more pro. From track record perspective, from the insights that he's able to share, from many things, like 100% YCX is more pro. The only things that I can add, which YCX is not willing to share, is that I can show up with a face here, and YCX only with voice, no face. That's the only difference. But come back. Even yesterday, right, the stuff that YCX share, right, for those who read his message, right, people are talking about printing money selling options, passive income, 20,000, and then YCX just come up with to tell you that selling put options, all these things is not a passive income. It is not good from risk return perspective. It's not good in terms of capital efficiency. I think those are really, really good sharings. So for those who are new, who just come to this channel, there's a Telegram group. Just click on the invite link and then just text me. My handle is there. Just text me, tell me that you want to enter this Telegram group. I will allow you to be in, and then you can just read through the message that YCX share. Yeah. So I think definitely good sharing there. More pro 100% YCX. Next one, why buy an ETF if you already own individual stocks you are convinced about? Yeah, I think there's no contradiction here, because let's say if you look at my individual stock holdings, right, it is like companies like NVDA, TSMC, Tencent, Google, Amazon, Apple. So you look at this individual stocks holding as a whole, right? It also looks like an ETF. You can call it like a Boon Tee ETF, right? And then do you ask, like, if you ask me, am I 100% sure that this Boon Tee ETF will outperform S&P or other passive index? I'm not sure. I just prefer to own these companies. I have conviction on the business, but I don't know whether it will outperform, because definitely there will be some businesses that I have not studied before that suddenly turn out to be 100x in the future, right? So this kind of companies that will bring up the, let's say, the S&P 500. So it might be these two companies that 100x in the next 10 years that bring up this company that make S&P 500 outperform the companies that I have, right? So it is possible. So that's why I would say that why not just have some exposure to all these passive market as well. So basically there are two bucket, right? One bucket for the individual stocks that I own, and then another bucket for the ETF that I own, and these are broad-based market, right? In fact, the other reasons which I talked about in the past is the estate tax management. If I want to 100% focus on the estate tax management, I will actually sell my entire portfolio and just hold some UCITS ETF, right? So over time, I expect my portfolio to drift over to ETF more and more. The reasons when I start up, I invested in individual companies because I look at all these businesses. I wanted to own these businesses, and if let's say I study Amazon, I said, "Whoa, Amazon is an amazing company. I want to own Amazon." Then you say you can actually own it through ETF, which is true, right? So if I buy S&P 500, look at Amazon, let's say it's like 4%, and I throw 10,000 in. 10,000, 4% is how much? Just $400. Then I look at $400. I was like, wow, $400. I want to have a sizable investment in Amazon. 400 not enough. So then I'll just like throw 5K, 10K into Amazon, right? So that's how I get the exposure into specific company quick, by just investing in individual stocks, right? But over time, once I have allocations or size that is good enough, and I want to diversify, then slowly I will just buy more all these market passive ETF. So yeah, that's my comment on this. And somehow my companies also have some restrictions when it comes to buying individual stocks. That's also the reason why I'll just focus on buying ETF. I'd like to ask about Reddit too. Hope there will be a detailed video and all of us in the group go in confidently and buy and 10x together. Yeah, I have no idea about Reddit. No idea. I don't know. Let me pass on this. Let me see on the YouTube comment sections. I do have one questions where Adam mentions there is a market rotations. When one sector will go up, then will goes up. Why do market rotation occur? Next, we all are aware that the buy and sell will not be better than buy and hold. What is the reason why the fund managers just keep buying and selling every now and then? Is it their comp? Okay, so let me address the first question first. The talking about rotations. So I think these rotations, it sounds very nice because people talk about there's some cyclicality in terms of market, right? Let's say like markets is going risk up mode, right? Then people want to buy into like cyclical stocks because it earn more money, and then when cyclical downturn, people shift into defensive stocks and so on, right? So I think all this sounds very good. And of course, if you look at the history, right, you look at all this sector performance, right? Of course, you can tell there's some cyclical. There's this cyclical among sectors. Even let's say if you look at stock, just market overall, right? You look, market is not like one straight up one. It also there's some sort of cyclical one. It's like wave, right? Up, down. And Adam Khoo, he likes to talk about wave up, wave down, right? So I mean, with hindsight, if you look at all these things, right, definitely 100% is there's cyclical to it. The problem, right, is that can you predict the cycle before it happens? Say for example, let's say market down, right, and then you predict that the cyclical is turning cyclical up, right? And if you are able to time that well, right? Of course, you are making tons of money. Market on average go up 10%, you can get 20%. Just be able to time it well, right? 100%. The problem is that it is very difficult because when you time that it is going down, right? You say that, oh, it's going up already, then you buy, then it down further. Then of course, when you panic, then you go up again. So of course, it is not easy to time. If you know how to time, then you will make money. But it is difficult. It is not like it follows some sort of formula, then it hits certain level, it will go up already. Even for those who are trading, they will say that, when I use all these indicators, it just tell me the probability is higher that I'm right. I don't believe that. I don't believe so. If it is so easy, right? Everyone trading, everyone make money. Then those who trade, they make money from who? Because the market is, right, you look at, imagine that it is a big pie, right? There's the market passive, and then there's the active trading part, right? The passive one, they will make 10% over time just because of the passive, they just earn market returns. And then those who are not passive, right? Those who are trading or they are doing, trading or more activities, right? They trade and then they make money. So of course, it is zero-sum game on the active part, right? So if you trade, you make money, someone is trading and lose money. And why the person's trading lose money? I believe that person will also try to time the cycle or time the sector rotation or time whatever, right? Why he lose money? If it is so easy, everyone should make money, right? So I don't believe it is so easy to make money this way. So that's a comment on the first question. The second question is asking about why fund managers keep on buying and selling, right? So I think tell you the answer is very simple one. The fund managers, right? There's no magic about fund managers. Fund managers is just human. It's just like you and me. It's just human. Is it proven that they are better as compared to retail? I doubt so, because among the retail, right, I'm sure that there are retail investors that are super good, and then there are retail investors that are super bad. But if you look at fund managers, it's the same. There are fund managers that are super good, and then fund managers that are super bad. The only difference that separate these two groups is that usually fund managers, they have, in terms of their style, in terms of their approach, they have a better framework. Okay, they can't speculate without writing down. For example, they have proper procedure, because sometimes their buy and sell might be audited, right? So they need to have some sort of let's say documentations to tell. They can't speculate like crazy without documentations. That one definitely separate them from retail investor. And then they also have better resources, say for example, like access to all this research, access to some of them might even have access to talking to the management, like Bloomberg, all sorts of things, right? So in terms of information and data, they have better access as compared to average investor. That is definitely true. But when it comes to behavior, right, they are similar. They are human. So they also panic one, I tell you. So there's nothing wrong with that. Just treat them as human, then you will understand. Okay. So yeah. It's not about their comp, because fund managers, they don't earn from buy and sell. The brokers, let's say if you're talking about brokers, broker will recommend their client to buy and sell, right? Broker will earn from your transactions. But for fund managers, if they trade a lot, right, they don't earn more. So that is not about the comp. What sector do you work and what restriction do you have? Yeah, I work in financial services. So financial services, right, they tend to have a lot of restrictions, especially when it comes to, let's say like individual stocks investing. So that's why I don't, it's not like say cannot buy at all. It's more like, for example, let's say if you buy and then you can't sell within X number of days, or let's say if you sell, you cannot buy back in certain number days, and before you buy, you need to get some sort of approval. So it's just this kind of things. It's not like restriction, cannot touch. It's not like that. It's more like the process is just lengthier, just a bit mafan lah. So yeah, that's why sometimes. But when it comes to, let's say like ETF, right, passive investing, we are free to buy sell. So that's why a lot easier lah. So there's some differences there. From Henry Chan, do you have any thoughts about SPMO versus QQQM versus SCHG as the growth portions in the portfolio? So I think you want to differentiate the strategy behind this because there are some differences. The SPMO I think is momentum, it's not growth, it's momentum. Momentum is different from growth. Momentum, right? You are talking about stock price momentum. Let's say the momentum is going down, then you will short. Then if the stock price is going up, usually I think it's like 6 months to 12 months kind of look back period, right? If it gets up, they will long. So you are talking about share price momentum. So let's say a company's even the growth rate is very low, right? If the share price is going up, they will just long, you know. So it's talking about momentum. It's not growth. QQM is, I believe it is the same as QQ. I think it's Nasdaq 100. So Nasdaq 100 definitely is pro growth because there are more technology companies inside, but it is still not a growth ETF. Why I say so is because, say for example, let's say Apple, right? Apple is definitely in QQQ because of Nasdaq 100, right? They're in, and the percentage is also relatively large. But if you look at Apple, their growth rate is not high, so it's not a growth stock. So it's different. SCHG, I forgot already. I think this is Charles Schwab. Yeah, this is large cap growth. I think the large cap will coincide with the QQQ, but the growth part, that's the part that is not, might be different. Let me check whether SCHG have the Apple inside. Also have, so I don't know. Maybe it's quite similar. I look at the list of their names, is quite similar to QQQ. Yeah, these two I think is similar, but when it comes to the SPMO, I think they are different. It gives a momentum. I think that's my comment on these questions. Okay, thank you so much for joining. I will finish up these questions here. Do you spend a lot of time self-reflecting or reflecting on life? The answer is no. I don't self-reflect. Self-reflect, usually you think about like the decisions you made in the past, stuff like that. I'm more like an easygoing person, so not so much about self-reflecting. But of course, let's say if during certain period there are certain problem that is like keep on, you know, like I keep thinking about certain things for a long period of times. I won't just focus on the thinking. I will you know, make use of, let's say, like all the AI tool that's available. I will try to read. I'll try to find some other things that give me extra input for me to break through the thinkings, right? So that's how I works, right? I don't you know, like sit with myself or just one person just think and just do this kind of self-reflecting. I don't do this kind of thing often. Okay, good questions. Thank you so much for all these questions. See you in the next one. Bye bye.
Alright, so there's this dude who walks into a bar with a slab of asphalt under his arm. Bartender's like, yo, what's with the roadkill? Dude says, this is my buddy Pavement. We go everywhere together. Bartender squints, says, you're full of it. Dude's like, nah man, we're tight. He's my wingman for the baddies. Bartender shakes his head, pours a whiskey, says, fine, but if he cracks, I'm charging you for the mess. Dude grins, says, don't worry, he's got a solid personality. Stupid, right?
I don't know what you are talking about. Okay, that's it.
You're lost, babe.